Okay, we're live. Welcome, everyone. Welcome back to the Business Success Series. So last week you heard from Lisa Campbell, who is the director and head of Profit First Canada. And it was such an amazing conversation with a lot of small business owners joining us to learn about how they can maximize their profits and manage their business very well. And the second part of our series is brought to us today by True North Accounting. It's a local small business accounting firm just like you, and they're helping other small businesses save money and time and grow. So the topic today is tax incentives and how to maximize your tax return. And today joining us is Dilraj. Dil is a partner at True North Accounting. So I'm going to now give the mic and stage to Dil to introduce himself and also tell us more about the True North Accounting.
For sure. Thanks, Amna. So my name is Dill. I'm a partner at True North Accounting, and True North Accounting is really designed for small businesses. What we do is help small businesses thrive, help small businesses grow, and especially in that beginning stage, when you don't really know what's going on and you don't have anybody to talk to, that's where we really come in. I think that one of the best things that we do is we're very relatable, and we make sure that everything we explain is explained in a simple way. Time and time again, I've heard from clients, prospects that my accountant doesn't really tell me exactly what's going on, and I don't really get what they're talking. And so we really flourish and try our best to make sure that we explain it in the simplest way possible and just be very relatable, because that's kind of what everybody's looking for. The services that we provide are, again, for these small businesses would be like notice to readers, compilations, bookkeeping, and so tax planning. We also do advisory services for our clients. So those are for those clients that are, have been there for a couple of years and they're looking to take that next step in their business. And yeah, the background that we have a partner who has his CBV, so he knows how to do valuations. So we're always there to help those clients and help them grow and help them succeed.
Sounds good. And Dil and I were chatting just a little bit. It seems like we actually share a lot of our career background. We probably have walked through and like crossed paths in the same hallways at Deloitte in Calgary. And then speaking with you just now, 5 minutes ago, you mentioned that your father also has a small business in Edmonton. And so you have been part of the small business upbringing your entire life, right? That's what educated you. That's what sort of raised you and brought you into this world and raised you to be the person that you are today. So a lot of small business owners struggle with, finding people and resources that can actually understand their pain point. And speaking to people like yourself, whose dad is a small business owner, and you're always like helping him and in his books, basically makes you more understanding of their problems and pain points and how to help them better. And I think that's one of the value that True North that I have seen working with Matt very closely in building Fuse Financial. He has been super helpful in providing feedback from and providing perspective of small business owners into the development of the product, right? To make sure that we basically build a platform that helps small businesses from the ground up. So with that said, thank you so much for joining us, Dil. Really appreciate. And if you guys don't know True North Accounting, please do check them out, reach out to them. Like Dil said, they're always willing to listen to you and help you out, understand your problems, and guide you in the best way possible to help you grow by saving money and time. So today's topic, the most interesting topic, everybody's trying to figure out, well, how can we maximize our tax return? The government of Canada has designed tax programs to benefit small business owners, right? There's incentives in there, there's some tax breaks. How can we simplify this? Because it's so hard to understand the tax code, right? All the information is buried. And honestly, as a small business owner, I don't have the time, right? I don't have the time. So I come to the experts like you to ask you to help me. And so this is basically more of an educational webinar for small business owners to learn. Like these are all the ways that they can actually take advantage of this, right?
Mhm.
And then reach out to their professionals that they're working with, accounting professionals or finance professionals, whoever they're working with, to make sure that they actually at the end of the year see that number of like that amount of return increase because they're taking advantage of all these programs. So the first thing I think I want to talk about that we will know from small business owners is the mileage and vehicle. So
Mhm.
whether you're a solo founder or like solopreneur or solo entrepreneur, sole proprietor, or you're a small business owner or you're a freelancer, you want to understand how mileage and vehicle can be claimed to reduce your tax payable and increase your tax benefit or tax return. So talk to us a little bit about that.
Yeah, for sure. I mean, I guess like the very first thing is that the very first question that we usually get from our clients, from prospects, is like, well, I'm buying a vehicle, and like, or I bought a vehicle and I bought it personally. So what do I do? And there's a couple of options that you have when it comes to mileage. You can actually take that personal vehicle and your business would be using it, and then you would be paid back cents per kilometer used for business purposes. So the way that it works is, to kind of keep it simple, you get 68 cents back on each kilometer that's driven for business purposes, right? Now, once you hit 5,000, that kind of drops down, but it's still a great incentive. And what the CRA is saying there is like, if you're taking a personal use vehicle, using it for the business, let us reimburse you for that,
Yeah.
right? Now, the other option, as you kind of mentioned, is like, well, okay, I'm buying the vehicle, but it's in my business, and that itself is actually something that you always want to talk to your accountant about and be like, okay, if you're buying a vehicle, let's talk about it, because there's certain things that you want to know about that vehicle, such as how many kilometers are you going to be driving, how much did you buy it for, right? How much of the percentage is going to be used for business versus personal, and then based on that, we can guide you and say, okay, I think the best case is to use it this way here, right?
Okay.
So let's say that the other instance, you have it and you put it in your business. Well, when you put the vehicle in your business, one of the most important things you need to understand is like, okay, how much of this am I driving for business purposes? Because everybody kind of looks at it. It's like, especially when they're new, they're like, well, I can write off everything, right? It's like,
Yeah.
hold on a minute. You can write off things that will help you and your vehicle grow your business and grow
Yeah.
your revenue. So those things being like your license, your registration fees, gas, your insurance, maintenance on that vehicle. However, if you're only driving it, let's say 20% of the time for business purposes and 80% of the time is for personal use, you're only going to get to write off 20% of that amount, of all that, the amount that you've spent. So you need to be very careful, because it might even be more advantageous then for you to just keep it personally and
Yeah.
take those kilometers that we talked about, right?
Yeah, a lot of the solopreneurs are like contractors, and there's 2.9 million of them in Canada, by the way. Like that's the number, right? Out of the 4.2 million total businesses in Canada, 2.9 million of them are just solo entrepreneurs or sole proprietors, right?
Okay.
And so they get told, oh, you can claim everything, right? Like you can claim all of your vehicle, like your house, like all of your, of course, all of your equipment that you're using for your business. So this is very interesting. So you're saying a small business owner, whether they're sole proprietor or a
Actually, no, sorry, sorry.
incorporated.
I want to convert. Sorry, I want to clarify that. That was for if you're a corporation, you have the
Yeah.
option of personal or business.
Okay.
Yeah,
And if you're a sole proprietor, you have the option of personal only, and then you
that's right.
claim the, okay,
That's right.
perfect. And then when you're claiming your mileage, you have a option. Do you have an option of just using the standard rate that Government of Canada has provided, or can you use your own rate as well?
So you can, I mean, and this is where you have to be careful, but for sure, you can use your own rate, because let's say that, 68 cents doesn't actually make sense because you're hauling a lot of things and it's a lot more wear and tear on your vehicle, because really what they're reimbursing you for is each kilometer driven. So if you can showcase that, look, 68 cents doesn't actually cover the wear and tear and everything that's happening with my vehicle, because I'm going out in the oil rigs and I'm hauling
Yeah.
all of these other things, well, then you could up that amount, right? Be ready, be prepared that the CRA may push back on that. But again, if it's reasonable and you've got a good accountant, they can fight that for you, right? You can
Yeah.
talk to them.
Okay, that's fantastic. Okay, and then is all the mileage as a sole proprietor covered, or do you need to like keep track that this is mileage driven for your customer? Like, how can you make this process so easy for small business owners? And I don't know if you use a template or
Yeah.
and you can help them sort of think this through. Like, what do they need to keep track of very easily on a day-to-day basis that would help them in case if the questions come out at the end of the year, like there's a review or audit from CRA, or even if to get to that amount of calculation that they need to put on their tax return?
Yeah, no, that's a really good question, and it's a question we get all the time, actually, right? So it's like, what do I do? And yeah, to your point, I'm not there. You can absolutely use a spreadsheet if you want to go as simple as possible. You use a spreadsheet, and each time you go for a drive for business purposes, you knock that down and you put, okay, this is where I drove to, right? And I'll get into that actually, what is considered business
Yeah.
purposes, but this is what I drove to, and this was the kilometers, and you keep that log so
Okay.
that at the end of the year, you add up all of that. We can do the math. We can figure out what you'll get as your write-off for, everything that you've done. But in case the CRA comes back and wants to audit the vehicle, you have all of the backup in the log. The other option is there is a lot of technology now that's at play. And, I mentioned to you, True North Accounting, like we try to be relatable. One of the other things we do is we like to use a lot of technology.
Yeah.
We like to really, and you're probably seeing that when you work with Matt a lot, but we
Yeah.
utilize a lot of technology. One of the apps we always recommend to clients is called Mile IQ. It's a free app up to a certain amount of uses, but it's a wonderful app because it's almost acting like a GPS. So when you're driving, it'll actually know, okay, you say, I'm starting my drive, you do your drive, you end the drive, it'll just keep that log for you. You'll be able to export it at the end of the month, and you can just continue to export it every month or export it at the end of the year. Provide it to your accountant, they can do all the math and they can figure out, what was the expense for your vehicle on that side.
Okay.
Right?
And is it just so for vehicle? Is it just the expense that is based on mileage, or are there other type of expenses that you can also claim?
Yeah, like we talked about, like the other expenses that you can claim. So, and I guess if we talk a little bit more now about corporations as well,
Yeah.
like in a corporation, you can claim what's called CCA, and I think we'll probably talk a little bit more about that. But capital cost allowance, and that essentially is just saying that, every year, and not to get too in the weeds in this, but it's called a class 10.1 usually, 10.1 vehicle.
Yeah.
And what that means is you get to claim 30% for the first year when it's driven. And what that means is, let's say you've got a vehicle for $30,000 that you've bought and you're using it for business purposes, like 80-90%. You get to claim 30% of that. So that's $9,000 that you can write off in that year again for the CCA.
Yeah.
To complicate a little bit more, first year there's a half year rule, so you would have to divide that by 2, but it's 4,500. But that's something that you get if you're a corporation and you have it under your corporation. The other expenses we did kind of briefly touch on, but you're gonna have your gas, you're gonna have your maintenance, insurance, and sometimes actually, like I was reading about this recently. It's like there's insurance, but then you might actually get extra business insurance, so that absolutely you can write off as well.
Okay.
And the simplest way I usually tell clients about this as well, not just for vehicles, but all expenses in general, is the CRA looks at it as like, does it help you earn business income or potentially earn business income? And if you're driving that vehicle to your job to go make income, then that is a legitimate expense, right?
Okay.
So, yeah.
Okay, so then licensing and registration fees, what I'm
Absolutely.
hearing, fuel and oil costs, insurance. What if you're leasing that vehicle, the interest on the borrow, like would you be able to write that off as well?
Yeah, for sure. So that's another conversation that always comes up. Is like, should I buy the vehicle? Like, should I buy the vehicle or should I lease the vehicle? And
Yeah.
I've always there's obviously a quantitative aspect to it, but there's a massive qualitative aspect to it as well. How are you
Yeah.
going to use the vehicle? How much are you going to drive the vehicle? Right. So again, that's great for your accountant to talk to you, understand your situation, and then discuss that with you. But
Yeah.
as far as your question, you definitely can. So leasing, it continues to change every year. But right now, the maximum that you can write off for a lease is up to $950 per month.
Okay.
Right? So if you're driving that vehicle 100% of the time for business purposes, you can get that $950 off of that lease.
Okay. And then if you said, like if you had bought it, but got a loan on it, right?
Mhm.
What about the interest expense on that loan? Are you able to write that off?
Yeah, absolutely. So if you're buying it, you're financing it, and then in that financing, there's obviously an interest component.
Yeah.
You absolutely can write off that interest component on
Okay.
that vehicle for sure.
And just to make this clear, like these deductions that we're talking about, these are for corporations, right? And for sole proprietors, what I'm understanding here is that the write-off that is available to them is basically mileage
Yeah, we
and
don't.
fuel
Yeah,
expense. And maybe like, do they have to say like, kind of like home office, which we will talk about and we'll get into.
yeah,
But is it kind of like home office where they get to say, well, I use this vehicle 35% of the time for my work, and then the rest of the time it's my personal
right,
vehicle, right?
right,
Like for example, think about Uber drivers or like gig
right.
workers and things like that. Where does that stand? Like, what are some of the, like, if you can streamline what are the deductions available to them? Because I think we just clearly understood what the deductions are for small business owners, but what are the deductions for sole proprietors? I think that would be great as well.
Yeah. Yeah. So as we mentioned, like we talked about the mileage, right? Again, if you're doing it 35% of the time, it doesn't, I mean, again, if you're using a calculate, if you're using, like I said, Mile IQ, you can still use that as a sole
Yeah.
proprietorship. There's no problem with that. But that'll tell you, because it doesn't, you only take it when you're doing business travel, right?
Okay.
So you would actually know how much you've actually driven for business purposes.
Yeah.
Um, and then we don't, so at True North County, we don't really deal too much with sole proprietorships. We
Okay.
are strictly working on corporations. But all of those things that you mentioned, like the gas, the maintenance, all of those things are still, you're still going to be able to get those back too.
Oh, okay.
Yeah.
Okay. That's perfect. So those are some of the expenses for vehicle and for mileage that you can claim. What are some of the other deductions that you can claim as a small business owner? And then how about we, to sort of keep this conversation understandable format, let's talk about the corporations first, and
Sure.
then we will talk about the sole proprietors and not mix each other, because then, like from this webinar, I want them to clearly understand what is applicable to sole proprietors, what is applicable to small businesses. So let's just keep that in that format. So yeah, let's talk about small business owners. What are some of the other deductions for tax purposes? Like, what are some of the other business expenses that they can deduct out of their at tax time?
For sure. And actually, to go back to that, it's because we started this way, but essentially the biggest difference between the sole proprietorship and the corporation is that CCA, because the sole proprietorship doesn't get that. But the deductions that I'm going to talk about now are going to be both for sole proprietorship and for corporation.
Okay.
So they're actually both the same. So we don't have to, it's for both, right?
Okay, perfect.
Um,
And we will talk about CCA
right.
right after that, just for the small business owner, so they understand what that is. It sort of is a bit of a complex, and they don't understand, then they don't need to understand. That's one of the other things that I want to tell small business owners. You don't need to understand completely to take advantage of some of these things. You just need to have the right tools in your environment, and you have to partner with the right team to help you grow, right?
Yeah, and I think that sometimes just having the awareness that they're out there, that
Yeah.
there's things that they're there for them, and then if they have that awareness and they look at that tax return from the accountant and be like, hold on a minute, like I don't see, like you said, office expense on here. It's just great to have that awareness, and then you're not in the blind, right? When an accountant provides you back a corporate tax return, some financial statements, you're like,
Yeah.
what is this, right?
Yeah.
So hopefully out of this chat, like some people can take away and see, okay, this is what I expect to see. These are things that should be there for me.
Right.
And I will, I guess, reiterate back to what I mentioned, and what is and what can you write off? Like, what can you have as a business expense? Well, as I mentioned before, it's like that rule, and I always tell this to clients, is if you're using it to earn business income or potentially earn business income, then you can write that off. And the
Yeah.
other way to think about it is, if I didn't have this business, would I actually buy this item? Would I actually have then this expense? And a great example is a sofa for your house. Well, okay, I'm like, well, you know what? I sit on there sometimes when I meet with people or whatever, but it's like, okay, but would I have this sofa regardless? Yes, that sofa is in my living room, my family, we sit on it. Right? It's not really necessarily a business expense, right? And Another example is like, well, in your office, you buy an office chair. Well, you need that because that is for your business. So something like that is a legitimate business expense.
Yeah.
Some common business expenses, like as you were asking about, one of us as an example, accounting fees. Accounting fees are a legitimate business expense. Why would you have accounting fees if you didn't have the business, right? So
Yes.
you've got that. The other one, a big one, is advertising, because anytime that you're advertising your business, you're trying to help yourself grow that revenue. So that is
Yes.
a legitimate business expense. You've got meals and entertainment, and this is an interesting one. And I don't want to go too deep into it, but meals and entertainment is a little bit different because what happens with it is you don't get to write off the whole thing. You get 50% of it. And the reason that the CRA does that is because if I go out and I'm a business, or you go out, Amna, and you're a business, and you go and sit at a restaurant and eat, and you're like, well, okay, but it's for my business. I'm going to write this off. That's not how it works. You have to be with someone talking about business for that to
Yeah.
be a write-off, right? So that's one of the other ones that come up. So if you're sitting with somebody talking about business, doing something business related, well, when you get that receipt, half of that will be written off for you, right? That's what you get.
Okay.
Charitable donations is another one. If you're going to be doing donations, you obviously get that as a write-off. That's even on a personal note, even if anybody does any personal
Yes.
donations, right? The other ones we can talk about, we talked about like business, like we talked about business taxes, licenses, memberships as well can be included in that. But the only one that's not included as far as memberships is like golf memberships. And those are not included, unfortunately. So do be
Okay.
careful when you're kind of going through them. And it's almost sometimes easier to see what's not included than what it is, because almost everything is, with the exception of like golf memberships, right? Recreation, dining, all that stuff. That is not included in that package, unfortunately, right?
That's really sad because I was thinking about getting a membership for a tennis club, just so I can meet other small business owners that are also like playing tennis. And one of the big things is like I'm not a drinker, right?
Right.
So I don't go and I enjoy a setting where we're all sort of connecting on our common interest, and I think that happens to be a bigger interest for me than doing meals and entertainment. So I was actually hoping that would be covered under it. So that's very interesting. So that's not covered. Is there
Unfortunately
specific
not.
reason the CRAs provided for
Um,
this?
I I mean, in all honesty, I think what you've said I've heard before, but they have specifically stated that like golf membership dues are not included. Yeah. But if you're now, no, so and to clarify that, if you're gonna be like you said, like you want to go to a private setting, you want to go for a meal with a client, again,
Yeah,
that will be included. It'll fall under meals and entertainment, right?
yeah,
Like under the 50%. There are other rules as well. Like if you've got a team, like you've got 5 employees and you guys all go out, there's a set number of times you can do that, but when you guys all go out, that will be like a full write-off. Like as example, a Christmas party. So
yeah.
you would be able to write off that full Christmas party, right?
Okay,
Um,
perfect.
the other one too, this one is more for corporations, but if you've got multiple shareholders, having a shareholder meeting is something that's eligible for a write-off. So that means that every quarter is usually when shareholders would meet. So the
Yes,
CRA allows up to 4 of those.
yeah.
Before they didn't mind if you went out somewhere else, but now they're kind of saying you need to stay here, like when you have a shareholder meeting. But that is included as a write-off as well. So you get 4 of those.
Interesting.
Yeah.
Interesting. Okay, so tracking all of this is a bit of a nightmare.
Yeah.
So how do you make sure? And I can talk a little bit about Fuse Financial as well,
Sure. Yeah.
and how that would help. And how that helps small businesses track these costs and keep them separate. So
Yeah.
tax time comes, you're not spending. Small business owners are not spending, weeks worth of hours on separating and tagging these expenses for their accountants to know exactly what these expenses are.
Mhm.
They're already there. You can just pull it in a report, and quickly get over your tax time.
Yeah.
And that was one of the big reasons why we wanted to do this series, is to show small business owners that to make tax time easy and to be able to take advantage of a lot of these tax benefits that are available to small businesses, they have to have a very organized accounting finance management platform that doesn't rely on 6 different apps, and your expenses are not spread across like 6 different places that you're trying to pull
Right.
together. So yeah, tell us about some of the
Yeah.
ways that you advise small businesses on how to keep track of these expenses, right, for their businesses to make the tax time easy for them. And also, I think you guys also help with managing their books as well, right?
Absolutely.
So yeah, so talk about some of the ways that you have advised small businesses about this.
For sure. And I think one thing I want to mention, like as you mentioned that, it's like there's so many. It's like, well, is it a write-off? Is it not a write-off? I don't know. Talk to your accountant for sure, right? Because
Yeah,
there is gray lines in there as well. So talk to your accountant and make sure you're on the same page so that you put it. Now, to your other question there, well, how do you keep track of all of this stuff, right? Well, the number one thing I think, as soon as somebody incorporates or starts a business, what's the first thing they do? They get a bank card, right? They go to the bank and they get the bank card. And now one of the things, biggest thing we always recommend is that keep your business business and keep your personal personal. Do not mix those two cards, right?
yes,
So if you do that, you're already a step ahead. So make sure that you're using your business card just for business purposes. Now, there's so many tools that are out there and that are available. So one of the ones that we use, like as far as receipts and managing all the receipts that are coming in, there's an app called HubDoc.
yeah,
And that's what we use for our clients. And what that does is like you would get an app on your phone, and with that app, we'd help you set it up, get everything loaded. And what happens is as soon as you get a receipt, you can take a picture of that receipt. You can recycle the receipt. It will sit in HubDoc, and it will sit. We the way that we do this is we hold it for 7 years, and that's the legislation. That's the standard that
yeah,
you have to hold it for. So if there's an audit, we can help support that audit because we have all of the receipts that are
yeah,
there for us, right?
yeah,
Um, the other big thing is that if you're using that business card, what you can do is like with different apps, like we use Zero for our apps. And what we do is we actually we take the CVS file of that statement, we input it into Zero. You can even log into Zero with your bank account. Not all banks are working right now, but they're on it, as you probably know, Amna. But
yeah.
once they're working, you put your information in, it logs in, and it just starts to take all of your statements and all of your
Yeah.
line items, right?
Your
So
tech stack is a little bit behind Fuse Financials. I'll tell you that. And great product plug. But so a lot of the problems that a lot of the time small business owners why they end up using their personal card is because they're not approved for their for a business credit card. It's a huge pain point, or the limits are so small that they can barely use it in a productive fashion. So they end up using their personal credit cards. And this is exactly what Fuse Financial helps you with. So you log into Fuse Financial, you apply for the account, you have a card, a Visa prepaid credit card that is available to you that you can start spending on right away. You can issue cards to your employees, so you get rid of all of that receipt chasing for your employees and then having to deal with missing receipts. And then your employees can actually add their receipts. They can take a picture of them. You can take a picture of them. You can attach them to the transactions, and we keep track of that as well. And within the platform, you can actually split the transaction. So if there were 5 employees, you can split the transaction, or there were multiple things that were bought in one transaction. You can split the transaction. You can put in the tax, and we seamlessly integrate into Zero. So all of your transactions get automatically input to Zero for your accountant to see. And you get a nice little report. You never have to log into your bank. You never have to log into your to another system. All of it is in one place. So this is what Fuse Financial is. It provides you with a bank account, with a credit card that you can make purchases online on. One of the things I was going to mention, how you can keep track of all of these expenses, is you can issue a card for your Christmas party or for your board, right? So all of those expenses that are happening on that for that purpose just happen on that card, and that card automatically gets categorized. And your accountant knows what the purpose of the card is, because we have put a field in that says nickname of the card. So you can say board meetings, you can say Amazon purchases, you can say IT expenses, you can say this is for meals and entertainment, this is for conferences, this is for membership. So that's how, and you can issue yourself like virtual cards. You can put them in your wallet. You can start spending on them right away. So that's how we are saving small business owners time, and organizing their books so that tax time is very easy for them. All of their expenses are organized. And one of the things that I've heard and talked to and talk about in some of the small business owners have told me is that for expenses that they have had, for example, they bought a chair for their office, right? But they bought it on their personal credit card because they couldn't get access to a corporate credit card. CRA came back and contested that expense because saying, well, it's purchased on your personal credit card, or they bought toilet paper for their business, but they also bought toilet paper for themselves, right? For their home on the same credit card. So they're like, well, how do you prove that, right? And the easiest way to prove, as Dil said, is to get a corporate card. Keep your business expenses separate from your personal expenses. And if you're having difficulty because the banks are not giving you a credit card or banks are not giving you high enough limit to justify, like to have all of your business spending organized and making it a chaos for you, you can always sign up for Fuse Financial, and we have a solution available for you.
No, that's actually so awesome, because I'm not what is happening all the time in, with new clients they're signing, especially when they're new to business. You're right. Those banks, those big five banks especially, are not offering that credit card.
Yeah.
So that is a great solution to go around that.
Yeah, thank you. So we have talked about some of the expenses that both sole proprietors and small business owners can claim out of their business. And for that, the best practice for them, first, most basic practice for them is to keep their expenses separate. Yep. And they can get those access to cards right away from Fuse Financial. And so let's talk about now the most difficult topic that small business owners have difficulty understanding, and which is such a benefit for them to own assets under their business, which is the CCA, right? Which is the, sorry, I'm not an accountant. So what does CCA stand for?
So it stands for capital cost allowance.
Okay.
And, yeah.
And what is it? So tell me in very layman, like.
Yeah, for sure. Yeah.
Try to explain it to me like how you would explain it to your dad, who's a small business owner but not an
Right.
accountant. And how would you tell him, Dad, you should buy this like this because under your business you can take advantage of this thing called capital cost allowance.
For sure. And I guess, like, to take a step back, it's like if you buy some staples, right? You go and buy some staples. You take it and you expense it. Yeah. And there's a point where it's like it's not expensable, and you're gonna have to write that off up over a number of years. And the way that works is because it's like it's gonna provide you a useful life of more than 1 year, right? It's gonna be there. I've seen, like, when I worked and did management consulting and worked different companies, they always had rules, and usually the big rule I'd see most of the time is over $1,000. If something is over $1,000, you're likely not going to be able to expense it straight off because it's likely going to be an asset, right? And if it's an asset, that's when CCA gets involved. And CCA simply is just like another word for it. Could almost just be depreciation. It's like how you have to, each year that you use an item, like you have, for instance, a nice chair. Let's say that, that chair, it's not going to be worth as much next year because you're using it and you're continuing to use it. So what the government has done there is that they said, okay, whatever asset you buy, you first put it in a certain class because they have different classes for all assets. As an example, if you buy equipment, it falls under class 8, and class 8 is 20%. So what that means is that if you bought a $5,000 item, and it falls under equipment class 8, you can write off 20% in that first year. So you can write off the $10,000. So you can't write off the full $1,000. But you can't write off the full $5,000. You can write off the $1,000, but that's it. And then next year you can do that again and again. And after a certain amount of years, that will be written down to 0, right? Okay. The big thing also, as I kind of have to always mention, is first year rule. Unfortunately, there's a half year rule. So first year, if it was a $5,000 item, 20%, it wouldn't be $1,000 you would get. You'd have to get half of that, which would be $500 instead of the $1,000. Okay. And then now you've got a $4,500 amount that's left in that class. And then you would write 20% again next year, and then again next year. And that's kind of how it works. Okay. And so what are some of the things that fall under this? Like if we want to kind of talk about.
Before you go into this,
sure. Yeah.
So small business owners don't think in terms of assets okay, what is considered an asset, right?
Right.
So let's talk about some of the things that would be considered an asset. When you mentioned like anything above $1,000, like one of the things that small business owners first thing they get is a website,
Right.
right?
Right.
So and they spend more than $1,000 on the website.
Right.
So would you say should they expense the website right away, or should they like if we can just even talk about this example across the board, like should they expense the website right away, or should they classify it as a capital asset and take advantage of the of this vehicle or financial tool that is available to them? What would you say for a website?
Well, the thing is with the website, and I guess and I'm sorry, but it will depend. It definitely
Yeah.
will depend on what you're using for and how you're using it. But the big thing also that I really want to say is that if you think about it, it is absolutely like a vehicle, like it is a vehicle, like CCA is a vehicle. But at the end of the day, if you're like, okay, you know what, this first year is like where I'm struggling, I don't have a lot of cash. You would
Yeah.
want to write off that whole thing the first year.
Okay.
Because it'll reduce your taxes, right?
Yeah. Yeah.
And maybe we'll get into that, but it's like because there's certain things that the government's recently done where they said, hey, look, like we know that there's CCA, but we're going to accelerate this for you because it's a tough time in the economy right now, and we want you to be buying items and we want you to be investing, you know, in the economy, right?
Yeah.
So yeah, so in the case of that, like CCA, like for a website, it does apply. It does apply, and again, it'll depend on like what you're kind of doing, what you're doing with it, and there's a different class based on that.
Yeah.
And then based on that, your accountant would put it in the right class and then start to claim the CCA. The nice thing about CCA as well is that you can choose not to use it if you wish not to. So as an example, like if it was like we talked about the $5,000 and you know you can claim the 500 on the first year, you can choose not to claim it if you don't want to.
Yeah.
So now you still have the $5,000 that's still left. And
Yeah.
that's a tax planning strategy, right, that accountants can use. And it really depends, again, on the client and the client's needs and their situation that they're in financially as well.
Yeah.
Yeah.
Okay, perfect. Okay, so I stopped you from going in a direction. So now you can proceed in that direction. Okay, so we talked about websites. So what is some of the simple ways for small businesses to think about this and take advantage of this vehicle?
Of CCA?
Yeah,
Or,
of CCA. Yeah.
Well, it's not, I guess, like, because ideally sometimes you might just be like, I'd love to expense everything. I would love to, but it's just not under the rules that you can, right?
Okay.
So like, as an example, like a vehicle, let's say you bought, you know, the vehicle for $30,000. It might be really nice to just write that whole thing off the first year and pay no tax, right?
Yeah.
But you can't. It's because like we talked about, like what is an asset? And at that point you have an asset because it's got a useful life of more than 1 year.
Yeah.
And it's providing you a benefit, right?
Okay.
So if it hits that, then you have to, unfortunately, put it
have
under.
to. Okay.
Yeah.
Okay.
Yeah. And that's a really good segue in a way. Like maybe we don't necessarily go there right now, but that's why the government added some initiatives to say, look, you know what, there is CCA, but we're going to allow you to accelerate it. So that's the initiative, is that you don't need to do that, you know, that little bit every year. We're going to allow you to accelerate even more. And maybe we'll get into that after. But the thing I want to kind of talk about is like sometimes people are like, okay, well, what would fall under this? Like what classes are there? I'm not going to go through every single class, but you know, the main ones that you really see a lot is like buildings, right? So
buildings.
Yeah, buildings are a big one, like class 1 buildings, right? So they're at 4%.
So it is like, okay, so building that you're buying or you're leasing or both?
A building that you would be like buying.
Right? Buying. Okay, because leasing would go under rent. So you are expensing that anyways. Okay.
You would be, yeah, exactly. So in this case, if you're buying that building, you know, that building, as we kind of talked about, everything deteriorates in a way, right? Especially assets. So over time that continues to deteriorate, and they're saying like, okay, 4% each year is what you're going to get for that building.
Okay.
Right. Another common example, we kind of touched on it, but I was talking about it: equipment, furniture, tools. Those fall under something called Class 8, which is 20%.
Okay.
Right? So there's that one. We talked about it in the very beginning. We talked about vehicles. So those are Class 10, 10.1. And 10.1 is 30%.
Okay.
So there are different ones. And I think this is where, you know, having that discussion with your accountant and just understanding that at the end of the year, if you've got a tax return, you would want to know that schedule. It's called Schedule 8. And you want to know what fell under it and where did you put my assets, right? So it's always great to know these things and to discuss these with your accountant for sure.
Okay. What about computer and software? Like those are some of the things of sole proprietors.
Yep.
I call them sole proprietors, but I mean like even the incorporated businesses that are just one person, right?
Yeah. Yeah.
They're consulting with multiple customers, but they're incorporated businesses. So talk to me about computer equipment, software that they are using to service their clients. How would that be treated?
So that one, I think I mentioned class 10.1. So that was vehicles. And I didn't
Okay.
say class 10 for a reason. Class 10 is actually where that falls.
Oh, okay.
So
Class 10 is where that
computer software falls under class 10 and it is 30% as well.
is 30% as
Yeah.
well. Okay. Okay. And then the useful life of your computer, you would say it's like 2 years, 3 years.
It's kind
They
of
come
saying
up
it's
with
like
a new model every
three and a
six
half.
months.
Yeah. I guess it depends what kind of computer you buy. But yeah, that's kind of how the CRA's kind of stated it under there. And you can always see it. Like if you ever had it kind of a question about it, anybody can go to the CRA website, just type in CRA CCA classes. First
Yeah.
Google result will show you all the different classes that are available.
Okay.
And they continually change, right? Because like when electric vehicles came in,
Yeah.
there was new classes for that and new
Really? Okay.
rules and initiatives for that as well, right? So
Yeah.
yeah.
So if you buy a Tesla for
Yeah.
for your business, what does the write-off look like? Just
So
for
it
personal educational purposes.
no, so I'm trying to think of the years, but if it was last year, it was actually accelerated to 100%. You could actually
Okay.
take 100%. I think when I last read it, I think it was 75% for if as long as it falls under, and the Tesla obviously falls under zero
Yeah.
emission, but I think it's 75% on the first year now. And
Okay.
then there's just kind of like a sliding scale as you kind of continue. But the government definitely was pushing electric vehicles
Oh,
at
for
that time.
sure. I think
Yeah.
so. The government does use these incentives and tax breaks or tax vehicles or programs that they have to incentivize the behavior that they want to
Yeah.
see in general public, right? So yeah, okay, that's pretty cool. I think you touched a little bit about when you said, well, but the government has said you can accelerate, right? You can accelerate
Right.
your deductions. These are some of the incentives. Actually, one of the things that I wanted to talk about was also, so as a small business owner, consultant, that you're working with multiple clients and you have a little corporation for yourself, and you have a home office. If you buy a house, how does that get treated?
So if you have if you buy a house and you've got a mortgage on that house, and now you're like, okay, but I'm a small business and actually I'm using a part of this house as my office, right? So the way that that works is now you can't write off the whole house, obviously, but what you can do is you can first figure out the square footage of what your office is. So you
Yes.
take the square footage of your office, divide it by the square footage of the total home, and that'll give you the percentage that you can use as the write-off
Okay.
for the home office. Now, what's included in that is not the mortgage, like the actual, like part of the mortgage, just the interest portion of the mortgage would
Yeah.
be
Okay.
included in that. You'd have your utilities, you'd have your gas, your any of those things would be kind of all included in that. So anything that's kind of going on in that home office or any of the things that are happening around that house, like even as an example, this was an example that actually happened for a real life client. Their heater broke, right,
Yeah.
and they had to fix it, and that was obviously run for the house as well. But a portion of that was obviously so that their office can stay warm and everything works there. So they got to write off a portion of that as well.
Wow.
So yeah.
Okay.
And what we do like at True North Accounting is we actually like send out a full sheet so that you can see all the different ones. And all you have to do is plug in your numbers there.
Yeah.
We'll do the math behind all of it and we'll make sure that we find you that write off. One thing I do want to say as well is like from a CRA perspective, because everything kind of comes back to the CRA,
Yeah.
is that the CRA, I think when they see on average anything more than 20%, it kind of raises a bit of a flag for them because they're like, why is it so high, right?
Yeah.
If you think about what your office would be compared to your home. Now, that's not to say that that cannot be the case. It just means that make sure that it's reasonable and that's provable.
Yeah.
A great example would be somebody that has a lot of inventory and they
Yeah.
put all their inventory in their garage. That is very fair to say that space is being taken up because of what's happening in my business. So yeah, you might pass
Yeah.
20% in that sense. But just be careful with that because I think when the CRA sees above 20%, they get a little bit, they could see that trigger go off and be like, why
Yeah.
is it so high, right?
Can you classify your house as a building that you're purchasing for your business?
If you buy, you can absolutely, like, sorry, can you classify your home that you bought personally?
Yeah, but you also have an office in there. But can
Right.
you put it as a building? If you're incorporated, can you put it as a building under your business? No, right?
No,
Like,
no. Like, you
yeah,
could sell it to your business if you wish to,
yes.
right?
Okay.
But there's other things that play in there because you might need to do a Section 85 rollover. That's where you get a little bit more tax. Yeah, we need to get into some tax stuff, but
Yeah, yeah, yeah.
yeah, you need to be careful because anytime anything happens, there's a deemed disposition, and if it moves somewhere else, there's a sale,
Yeah.
and that always triggers some kind
Yeah,
of
I'm just putting myself in the headspace of a small business owner, right? Given 2.9 million of the businesses that are incorporated in Canada are zero employee businesses, right?
right.
And then sole proprietors are on top of that. So that's why I'm saying, like, I'm putting myself in their mindset, and what are some of the things that they deal with in a day-to-day basis,
Absolutely,
right?
absolutely.
And what are some of the questions that could come up in their mind
Yeah,
that they could benefit getting an answer for,
yeah, yeah.
from a session like this.
I think,
Okay.
yeah, and actually speaking on that, I would go back to vehicles because I think one question I always get a lot of, right,
Yeah.
is, well, I don't actually work from home. I go to the office, and I that's where I work out of, is my
Yeah.
office. So I drive from my home to my office. Can I is that business travel? Unfortunately not. Not by the
Yeah.
CRA's rules. Going from home to your place of business is not considered a business expense, unfortunately.
Yeah.
However, if you go from there to a client site, that would be considered. And then client site back to home, that would be fine as well,
That
right?
would be fine as well. Okay.
So yeah, just to say, like, that's one thing that I see pop up a lot. Um, and yeah, that's one thing that people are always asking about. And then as far as like home office, I find that there is a lot of questions that come up on home office, and that's why we always kind of provide a template and then have a discussion with them as well, because
Okay.
you every situation is different for every person
Yeah.
because it's the way that they're using their home. What if you have a baking company? Well, now what do you do with the kitchen, right?
Yeah.
Like, so those are things that, talk to your accountant and really like get the understanding of like what you can and cannot write off in that case, because it's now all of a sudden a little bit different, right? You might
Yeah.
have an office you work out of, but you've also got this kitchen space that you should be able to get some write-offs out of as well.
Okay.
Yeah.
That sounds great. So talk to us a little bit of incentives that Government of Canada has out for the 2023 tax year or
So one of
2024
the
tax year.
so one of the ones that we kind of start to touch on, like we talked about, there's accelerated, it's called like the accelerated investment incentive. And
Yeah.
really what the government's just trying to do is that it's a temporary measure. It's not going to last forever. I believe it was like November 2018, and it's going to go until 2028, as
Yeah.
long as it's like bought something useful life within that time period. But what that is just, we talked about CCA, and we talked about, how there's rates and there's certain amounts. Well, this one is saying you can accelerate that. You
Yeah.
can go from, let's use an example. You've got the $10,000 amount. It's class 8, so you get 20%, right? I mentioned there's a half year rule. So instead of, $2,000, you get $1,000 in that first year, right?
Yeah.
For write off. In this case, what they would do is you could almost multiply that by 3. So instead of $1,000 in that first year, you would get 3,000. And what they've done is they've taken what you would normally get, especially in the first year, and times it by 3, or in other words, times it by 1.5.
Yeah.
So they're allowing you to accelerate and get more of that upfront, right? Like tax deduction. Now, the important thing to understand there is that because you have $20,000, and let's say you write off 3,000, now you only have 17,000 left.
Yeah.
So now when you you accelerated it, but it's not like you're getting still the 20,000. You now have 17,000, whereas in the other scenario you would have 19,000.
Yes.
So it's all about tax planning. It sometimes makes a lot of sense. Let's say somebody's in a tight cash position. They need that cash flow. They need to make sure, they can't pay those taxes that first year. Yeah, let's accelerate it. But in other times, it might not be the right thing. So it's always like, talk to your accountant and really figure out, does it make sense? Yeah.
Perfect. Anything else you want to add to the incentives?
Yeah, like the one other thing there is like when you do something like that, like the CRA has very strict rules in that, because what people start to do is just buy from their family. You can't do that. It has to be what's called an arm's length transaction.
Okay.
And that means somebody who's not your family, right?
Yeah.
Somebody that's outside of your family. We touched on zero emission vehicles. they are not actually allowed as part of this incentive because, again, they have their own fast forward rates that we talked about, right? So that would be pretty much it. You don't, again, have to apply the half year rule when you do this one. So there's advantages there. There is the other one that we can also talk about. It's called the designated immediate expensing property.
Okay.
And what that one is that this one was started in June of 2022, and it's going to go until about, I believe, 2025 as of now. It initially only started with corporations, but now it's eligible for non-corporations as well. It's not allowed for trusts, but talk to your accountant, make sure that it is allowed for you, but it is allowed for non-corporations. And what this one is that you can write off up to $1.5 million based on if it's an eligible expenditure, right? And what they do is you need to make sure that you have it cannot be a building. There's some restrictions to this. You cannot have it as a building. You cannot have goodwill. But yeah, otherwise you can actually go ahead and do that and write all that off. Again, back to the CCA comment about what I made earlier, you can't carry it forward. So if you don't use it the 1 year and you're like, well, I didn't use the full 1.5 million, you can't just carry it forward, right? So you have to use it in that year or you don't use it in that year. And if you take the deductions now, that all that means is that you're going to get less down the road. That's something you have to understand as well, right?
Okay.
Yeah.
So you're basically taking the tax deferral, but that money is more important to you. If you look at it from the time value of money, you're getting that cash in your hand faster in the years that you need for your business to grow.
Absolutely. And that's where it makes a lot of sense. But there's other situations where somebody's not making a lot of money in that first year anyways, right?
Yeah.
So maybe they don't want to necessarily accelerate anything and they want to actually save that up for the years that they're going to be making money, right?
Yeah. So kind of if you think about it from a personal, because a lot of people have a lot more experience with personal taxes. So it's basically like RSP, right? So the years that you're not making a lot of money, you may not want to take an RSP, make investment in your RSP. I'm not giving investment advice at all. I'm not an investment advisor. I'm just kind of thinking this out loud. So to think about it from a perspective, so when you have higher income, that's when you want to take bigger deductions. So for example, in this year, you just launched your website and you don't have that much income that you would be generating a lot of tax payable, then you don't need to take this deduction. You can basically defer it to the year because your website is still usable, right? It's still producing you money, it's still bringing you leads, it's still bringing you customers. So you can just do it for year 3 or 4 or 2 when you're making a lot more money.
Absolutely. And the thing is, we see that a lot with our clients sometimes, right? Where you can have they have the equipment, they can take the 20%, but it was a bad year. Think about COVID as an example. That was a tough year for a lot of people, right? And so there was a lot of deferral of that CCA into the future years when you know that you're going to be making more money again. Yeah. It's
That's fantastic. Well, we have coming up to our time as well. It's 12:52, and I want to put it out there from there are a couple of questions. So question came in: if I have income from foreign sources, what deductions are available, and how does the taxation of foreign income work? I would definitely recommend, I don't see the name of the poster, so I definitely recommend connecting with Dill afterwards so you can get more one-on-one, because I do think the question is a bit generic, so Dill can speak to it in a very generic way. But feel free to connect with Dill afterwards as well. So I just wanted to caveat that.
Yeah, for sure. Yeah, and exactly. And in all honesty, I think again, foreign source, and it depends where is that foreign source. I think it makes a big difference in that sense. And at the end of the day, if we're going to go as simple as possible, there's an income from a foreign source because you did some consulting work out for the US. The nice thing about the US in that sense is you don't have to charge GST because they don't have GST. So there's no applicability there. But you would put that income, obviously, as you would translate it, if it's coming in as USD, translate to Canadian and show that on your Canadian tax return, right?
Yeah. And if your company, for example, if you were being paid as a consultant and they did, or an employee and they deduct taxes, Government of Canada and US have a
tax treaty.
A tax treaty as well. So that's why I'm saying, I think it's important that you reach out to Dill afterwards to discuss your situation a bit more in detail, just because from the question we can't really tell and advise you in the best way possible. What we can tell you is in a very general way how we would go about helping you. But yeah, so
Yeah.
and the second question we have is, are there tax deductions for implementing health and wellness program for employees or personal health expenses?
Yeah, this is a question that shows up a lot, and I always kind of like, always want to kind of refer back to the financial planner and just make sure that they find the right incentive that works for them. I do know that there's absolutely some of those out there, and again, it depends like what would work best for you. But there absolutely is, and some of the rules, like I think one thing we normally, and you said it yourself, like sometimes what we're dealing with is a one-person business. You
Yeah.
have to sometimes be very careful, or one person and their family member, right? So you have to be very careful. You have to make sure that, if you have employees, it has to be eligible for everybody.
Yeah.
It cannot just be for yourself, but there absolutely are deductions available for that. So you just have to choose the right company, because I know there's one that, that I've heard of recently that works really interestingly, is that they would take your claim, whatever your claim is, they would charge you the extra 10% on that claim, and then they would give you the deduction on the personal note when you actually your personal taxes. So there's different things that are out there, and I think for small business.
Okay, sorry, clarify this because I didn't understand that.
For sure, yeah. Like, and I was kind of just looking into it recently. To be honest, I was talking to a financial planner. They were telling me, but essentially what they were saying is like I don't know. I actually don't remember the company's name, but what they do is like, if you have, let's say I went to the dentist, I have no benefits whatsoever. I go to the dentist, it costs me $1,000, right? My understanding is like I would pay the $1,000 obviously at the time there, and then I would send my bill over to this insurance company, and then they would say, okay, what you owe us is $100 because we're going to charge you $1,100 for this, and then they're going to give me the receipt for $1,000. So I would get the receipt for $1,000, which I can claim when I do my taxes and claim that back, right?
As a health,
I don't have to pay.
Yeah. And you can also claim like unpaid medical bills through medical and health benefits if you are just a sole proprietor as well. Just putting that out there if you wanted to do that as well. Well, are there any questions that people would like to get answered? Any comments? Okay. I don't see anything come up. But feel free to reach out if you would like to learn how to use Fuse Financials to organize your business. So tax time is a breeze. I'm here. You can reach out to me on LinkedIn. You can book a demo on the website if you want to, and you definitely need to reach out to Dill and folks at True North Accounting to help you understand and advise you on how to maximize your tax return and maximize the incentives that are available to you. They're also available. Their website is truenorthaccounting.com, I believe.
Yeah, it's truenorthaccounting.com.
Okay, I'm not sure about the .com part. And you can reach out to Dill and Matt and the team on the website, and they will be able to help you out right away as well.
Awesome.
And Matt is messaging. He's like, great tips. Thanks, Matt. Awesome. Well, thank you so much for your time, Dill. I really appreciate this. And thank you folks for joining. And we will be posting this webinar, so it will be available to you. And in collaboration with True North Accounting, we'll be coming out with a tax white paper or a guide for you as well to help you guide in the 2024 taxes.
Awesome. Well, thank you so much, Amna, and thank you for everyone listening. Thanks.
Okay. Take care. Bye.